Everyone talks about Enron like it was the worst financial scandal in history. It wasn't. Enron wiped out $20 billion and destroyed thousands of lives, but it's barely a footnote compared to what actually happened in corporate America. There's a pattern to financial fraud that repeats every time, each scandal bigger than the last, exposing the same weakness. Regulators don't see it, auditors don't catch it. By the time anyone notices, the damage spans trillions of dollars. The pattern starts the same way every time. A company manufactures growth that can't come from actual business. Accountants invent numbers. Auditors look the other way. When it collapses, it takes everything with it. This is what happened to WorldCom, Bernie Madoff, Wirecard and Lehman Brothers. Scandals so massive they make Enron look small. What should terrify you is that the conditions that created those frauds are still present. The same accounting tricks are being used. The same auditors are failing. The same regulators are blind. These weren't schemes by isolated executives. These were systematic deceptions embedded into major corporations. They involved auditors, board members, and regulators. So everyone whose job was to catch fraud looked directly at it and said nothing. That's the pattern. WorldCom was America's second largest telecom company. The dot-com bubble created impossible pressure to deliver growth. Executives fabricated revenues by creating $3.8 billion in fake accounting entries. When discovered in 2002, total inflated assets reached $11 billion. Investors lost $180 billion. Over 30,000 employees lost their jobs. CEO Bernie Ebbers went to prison for 25 years. But here's what disturbs you about WorldCom. Arthur Andersen, the same firm that signed off on Enron, was also WorldCom's auditor. They looked at the fake entries and certified the statements as accurate. The fraud lasted for years. This wasn't negligence. The auditors weren't incompetent. They chose not to look hard enough because WorldCom paid them millions in consulting fees. When your auditor also sells consulting services, there's a conflict of interest no certification overcomes. $100 billion fraud hid inside a major corporation for years while auditors said nothing. Then came Bernie Madoff. $64.8 billion, the largest Ponzi scheme in history. Madoff promised wealthy clients consistent annual returns regardless of market conditions. 8 to 12% every year. When investors handed over money, he deposited it into his personal account. He paid fake returns to earlier investors using money from new investors. Account statements were fabricated. Trading records were invented. The returns never happened. Madoff created an entirely fictional investment operation. The fraud was completely hidden. At least with Enron, a business existed. With Madoff, there was nothing. No trades, no investments, no actual profits, just a bank account and fake statements. Harry Markopolos figured out the fraud in 1999. He sent reports to the SEC multiple times. The Securities and Exchange Commission dismissed every complaint. They closed the investigation. The same regulatory agency that protects investors decided Madoff was legitimate. Madoff was chairman of NASDAQ. He had credibility. He had connections. That protected him until 2008 when the FBI finally arrested him. $64.8 billion stolen, and nobody saw it coming because the institution that could have stopped it chose not to look. Wirecard was the biggest accounting scandal in European history. A German payment processor invented almost $2 billion in revenue. The company ran money through suburban houses and empty rice sheds in Asia. Glaring red flags nobody wanted to acknowledge. EY refused to verify massive cash reserves because records were fabricated. KPMG couldn't verify billions in profits, but the company kept operating. Investors kept buying because the narrative was compelling. A German fintech disrupting finance. German regulators didn't investigate. They defended the company. BaFin filed complaints against short sellers questioning the numbers. against people trying to tell the truth. The fraud lasted until Financial Times journalists published investigations. Wirecard collapsed. Investors lost billions. The CEO went to prison. The auditors who signed off on falsified statements faced fines while executives faced criminal charges. Wirecard revealed that major multinational auditing firms will certify false statements if the client is large enough and fees are high enough. Lehman Brothers was different because it triggered the financial system to fail. The company concealed over $50 billion in loans by masquerading them as sales. They moved toxic assets to Cayman Islands banks temporarily to inflate balance sheets. The SEC knew and did nothing. Lehman was too big, too interconnected. When Lehman collapsed in September 2008, the banking system nearly failed. Credit froze. Lehman's bankruptcy was $600 billion, the largest in American history. The deception about Lehman's true financial position contributed to the crisis. That's what separates Lehman from other scandals. Enron destroyed shareholders, WorldCom destroyed investors and employees, Madoff destroyed retirement savings, Wirecard destroyed European investors, Lehman destroyed the global economy. Millions lost jobs, homes and savings because a major institution's true condition was hidden through accounting tricks. The pattern is undeniable. Each scandal involved the same mechanics. Creative accounting designed to hide problems that couldn't be solved through actual business. Auditors who looked the other way. Regulators who missed obvious warning signs or chose not to act. Enron wasn't the worst scandal in financial history. It was just the most famous. The scandals that followed were larger, more destructive, and exposed deeper failures in systems designed to protect investors. Here's what should terrify you. The conditions that created those frauds are still present. Companies manipulate earnings through creative accounting. Auditors have conflicts of interest from consulting contracts. Regulators prioritize protecting established institutions over investors. The next scandal is forming right now inside some corporate office where executives decide that the gap between actual performance and the stock price they need is too large to close honestly. They'll start with small manipulations, then larger ones, then entirely new accounting systems to hide the truth. The auditors will sign off because the fees are too high to refuse.